Today we're going to talk about this topic whereby there are two investors with you whenever you invest in real estate. So why is it that a lot of investors, they like to see real estate as a form of safe haven investment? If you have $2 million cash and you decide to invest into this property, what is the better return on my capital? This is your first investor. The bank is your co-investor because they co-invest 75% into the property. So who is your second investor? Your second investor is feeling like a brand new me. For the very first time, I'm right where I'm meant to be. So why is it that a lot of investors, they like to see real estate as a form of safe haven, all right, investment? One of the reasons is because whenever you invest in real estate, there are two investors that come alongside with you. Let's have a look at who are they. Now, let's have a look at example A and B. We talked about this concept before, whereby one is a non-leveraging kind of portion, one is a leveraging kind of concept, whereby in Singapore, you can only loan up to 75% on your mortgage. So for example, let's say you want to invest in a property, $2 million. Down payment is $500,000. Of course, that comes alongside with fees. Your buyer's stamp duty, which is 4 to 6%, your legal fees, and of course, with that, when you want to exit the property, there's going to be exit fees. For example, you need to pay your broker 2% to sell the property. All right. Now, on a generic level, when you look at an investment, 75% LTV, loan to value ratio, is what you can leverage for the bank, provided your TDSR passed the test. So your total debt servicing ratio, once you take into consideration your tenure, your loan capability, as well as your overall age category, depending on whether are you putting in 25% to go up to maximum 65 years old, or let's say you put in a high amount of down payment, you can actually stretch to 75 years old, but that's a separate topic. But coming to this, generically, most people, they invest in real estate with this approach. 25% down payment, in this context, 500,000, 75% from the bank, $1.5 million. All right. Now, if you have $2 million cash and you decide to invest straight on into this property, the main concept and ideation is like this. I put in $2 million cash. What is the better return on my capital? Because, for example, if I have $2 million, is it better off for me to put in $500,000 in 4 properties? Or is it better for me to just put into one property at $2 million? All right, so this is the main concept about real estate investing, is because with leverage, with a healthy leverage, and this is a healthy leverage, and banks are very willing to loan to people for mortgage loans, because why? The asset is the collateral. In the event, let's say you cannot pay your mortgage on a month-to-month basis for more than 3 months, then they can take back a property, all right? And then they can auction it off, they can sell it off, they can collect the assets. And the leveraging portion of 75% comes from the bank. Of course, now in Singapore, you cannot buy 4 properties unless you got 4 names, or unless you're willing to pay the ABSD. But the main ideation of real estate investing is like this, is that there's a multiplication formula on a very healthy way. And coming back to the screen, naturally, your return on capital will be very different. Because, for example, a fully paid scenario versus a good debt scenario, the return on capital, if you leverage healthily from the bank, is 80% return on capital, ROC. Because you put in 500,000, you make 400,000, that is an 80% return on capital. You put in $2 million, you make 400,000, that is only a 20% return on capital. So coming back to this screen is that here, you put in 500,000, you make 400,000, 400 over 500, that is an 80% ROC, return on capital. This is 80%, 80%, 80%. But this, you only have one property, is only 20%. Now, the multiplication leverage comes when each of this property increase in their valuation. Because here you have 400K, 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 400K. In total is $1.6 million of appreciation. Over here, is only 400K. Just by this difference, you have the same amount of money at the start, but your profit in terms of return on your capital is very different. This is $1.6 million. This is 400,000. So thereby we see the difference in terms of leveraging versus non-leveraging approach. Now, of course, there's various mechanics. It depends on ABSD and stuff. But let's say in the country with no ABSD, this is how people usually invest in multiple properties. But the kicker is this: you must be able to sustain the monthly installment. If not, what's going to happen is that the bank can take back because your asset is collateralized. All right, so you must be able to make sure that your cash flow is good to sustain, and there are periods of vacancy. Let's say you want to rent them out, and what if the property depreciates? You need to take into consideration all these risk-on factors. So just a recap on a previous episode we had, I talked about the 4 quadrants on analyzing real estate investment. We look at the first one is capital preservation, to make sure that this asset doesn't depreciate. So you need to do your numbers analysis data to make sure that this zone, this particular asset, has a very low chance of depreciation but has a high chance of growth. Second portion will be your tax efficiency. Third one will be your cash flow portion. And of course, the last one is that everybody wants to hunt for real estate that can appreciate, because any real estate that stagnates in value, basically it consumes your time and opportunity costs. Today's topic is about the 2 investor. So the first investor will be the bank. This is your first investor. The bank is your investor, your co-investor, because they co-invest 75% into the property. And the beauty is that the bank do not need to share your profit. So banks are not interested in your 400K. They are only interested to make sure you can return me the money that you loan at the point that you sell the place or at the end of your tenure. Or they are also very interested in the monthly interest that is gained from here, because there's a P plus I component. So coming back to the screen here, let's say for example, I invest in a property $2 million. I put in 25% down payment, 75% is from my co-investor, which is the bank. They are only interested in the interest payment, because when I loan 75%, I need to pay a monthly installment of, let's say, for example, $6,500. Now, within this $6,500, it depends on the spread versus your SORA rates. There's a principal component and there's an interest component. So just a hypothetical example, $6,500, your principal could be $4,000, your interest $2,500 a month. All right. So the bank is only interested in this. Why? Because when they co-invest with you in this property by giving you 75%, they earn $2,500 a month. So they are very interested in this, and they are very interested to take back their money in terms of the balance amount that is due to them at the point of selling your property. Let's say you sell a property within 5 years, they earn 5 years of interest, and they want to take back the balance amount that they loan to you. So naturally, after 5 years, you pay down the interest and principal. The amount that you owe them will not be 1.5 million. Maybe by then it will be 1.35 million, example. All right. So they are only interested in the monthly interest and the amount that they will take back from you. Now, they are not interested in the profit that you make, which is why real estate investors love to invest in real estate. Is because this is unlike so-called like investing in the company together, that when you sell the company, all the shareholders will be distributed accordingly based on the sale price, based on their percentage. But take note of this, when you come back to this screen, even though the property has appreciated to $2.4 million, the bank do not want your 400,000 appreciation. They are just keen on the original amount, the balance amount due to them, and the monthly interest. And the moment you can pay monthly interest, you're consistent, your cash flow, they will not touch your property because the collateral recovery is not activated. Now, if I talk about this P plus I portion, then I want to introduce to you your second investor. So who is your second investor? Your second investor is your tenant. All right. So a lot of us don't realize that when you buy a property to rent out, you buy investment property to rent out, you invest in this property, your tenant is your co-investor as well. Why? Let's say you rent out this property and the rental cannot fully cover $6,500, and there's also MCST fee involved, let's say $400. Your outgoing is $6,900 a month. Of course, there's still an annual property tax, but it's only fair that as the owner, I pay the property tax. Whoever is the owner pay the property tax, all right? The tenant, let's say, pays you $5,500 a month for this 3-bedder that you invested in. It cannot cover the $6,500. There's a shortfall of $1,000. And this comes from you as the owner, as the original investor. But this is your second co-investor. Your first co-investor will be the bank that supplies you with the initial investment, 75%. Your second co-investor is the person that co-invests with you on a monthly basis to take care of the P plus I portion, principal and interest, so that you can pay back to your first investor. So this is the concept that a lot of people, they don't realize that actually they have two investors together. One is for the initial investment, one is for the sustainability of the investment, which is what makes real estate beautiful. Because your second co-investor, the moment you rent out your property, let's say for 2 years, for 24 months, of course, sometimes there's vacancy period and stuff like that. But then once you rent it out, majority of this 5.5 is used to pay your principal fully and to pay your interest. All right. So you can look at it another way, is to pay your interest fully and the balance is for your principal. Both ways work. All right. You only need to substantiate $1,000 into the principal and then it is taken care of on a monthly basis. So you as the main owner, you come up with 25%. You come up with $1,000 on a monthly basis. You come out basically with the MCST fee, the property tax, and your buyer's stamp duty because you own the property and because your two investors are not interested or they don't have the rights to your profit. If you were to make a profit 4, 8, 10 years later, it's only fair you pay the MCST fee, you pay the property tax, you pay the BST. And the exit cost. Let's say you want to sell the property, you pay 2% to a realtor to sell. Because you have all the rights. By paying all this, you own the rights to the full profit. That's how it works. And everybody benefits. Your second co-investor is a tenant. They get to enjoy the utility of the property. They stay in the property. Your first investor enjoy the interest. But the beauty is that by exchanging this utility, I let the tenant enjoy the space, the tenant pays the interest to the bank, and the tenant also pays the principal that will be unlocked when I sell the place. Because, take note, how it works is like this. Today, 2025, I put in 500K to this property, I loan 1.5 million from the bank. 2029 when I sell, my balance is 1.35 mil. Why is it that my balance dropped? It's because for the last 48 months, I pay off the principal plus the interest. But the interest of 2,005 is being paid for by my tenant that pays 5,005. And my tenant also pay another 3,000 to my principal, which reduces my loan balance. And I pay another 1,000 to reduce my loan balance as well. So on a hypothetical basis, let's come to the screen. If I were to load up basically our PropertyLimBrothers calculator, let's say I'm 45 years old. I invest in a real estate $2 million, 1.55 interest rate, 25 years because the bank takes 65 minus 40. It gives you 25 years. Of course, after 1 year, you can refinance and stretch to 75 years. That's a separate topic. Loan, 75%, 1.5 mil loan amount. Monthly installment, $6,034. All right. What is going to happen is that when I look at my amortization table, it looks like this. So every month, 4,000 goes to the principal. About 1,009 goes to the interest that the bank is interested in. But what happens on a month-to-month basis? Let's say I rent out $5,500. All right. 5,005, about 2K is used to pay the interest. I left 3,005 to pay the principal. I myself, as the owner, come out with $500. All right. So basically, what is going to happen is that because the tenant is taking care of the bank's interest, so the tenant, as a second co-investor, pays the first investor. All right. And the tenant also contributes to my principal to pay down my loan because my loan is going to reduce on a month-to-month basis. And by the end of, let's say, 4 years when I hold a property, what is going to happen is it will look like this at month number 48. So month number 48, my loan balance is going to be $1.297 million. $1.29 million. Originally, my loan was 1.5 mil. And there's a reduction of 210,000. And this is being contributed by my tenant and myself. And my tenant is taking the bulk of it because I pay 500. My tenant pays 3,005. Another 2,000 that my tenant pay is basically to pay back my first investor. All right. This is the P portion. This is the I portion. This whole portion is paid by my tenant. So now that you have a good visualization of actually there are two people investing with you, and the second co-investor is actually helping you to pay the first investor, and the second co-investor is helping you to pay down your loan in exchange for the second investor to have the chance to stay at a property. This is a win-win-win scenario. So everybody wins. The property owner wins, the bank wins, the tenant also wins. And the beauty is that when you unlock this property, if I were to sell, because originally I put in 500,000 as the original owner, but how do the tenant benefit? The tenant get to stay in the place without coming out with 500,000 and all the risks involved as an owner, right? Because as an owner, I'll still have to pay MCST, property tax, and BSD and exit fee. But the tenant gets to stay in the place immediately, which is why people want to rent. They don't have to come up with the initial investment. They don't have to qualify for the loan. So it's a very fair game. Everybody has its contribution and has their own wins. All right. As a property owner, the moment I get the appreciation of 400,000, this comes to me and not to them. So the beauty is also that the tenant is contributing another 210,000 cash flow, and I get the profit. I get back my 500,000. So when I sell my property, I get back three things. I get back my original investment, 500,000. The tenant contribute and store into my property the principal that they have helped to pay over the last 48 months. I store another 210,000. I profit because the property I selected very wisely as an investor and it appreciates. I get 400,000. All in, when I sell, I unlocked 900K plus 210K. I unlock a total of $1.1 million. With my initial 500,000 in, my profit of 400K, and I earn another profit of 210K over 48 months. But of course, you need to store this. If you spend it, then you can't see it, right? So usually how do people spend it is that they use it to pay for the installment, all right? So of course, you don't get to see this. This is like hidden. This is hidden because your monthly cash flow is only $500. Of course, another way to think about it is that, okay, if my monthly installment is $6,034, some people like to play this mental game, all right? They have two bank accounts. So they have a collection account from the tenancy. So every month they collect 5,005. They leave it there, all right? And then they use their own account. They pay 6,034. They just keep paying it. And at the end of 48 months, they see this as one lump sum. All right. But of course, what a lot of people do is that they don't do it. They improve their monthly cash flow. They just take this collection, pay the monthly installment, and they themselves top up another $500. All right. So your monthly cash flow is only $500. So technically, you don't see this 210K being unlocked. Why? The rationale is because you already use it to pay for your monthly installment. But what do you get at the back end is that when I sell my property at $2.4 million, I less off my outstanding loan of basically over here, 1.29. Hey, where's my 1.29? All right. So let me round to 1.3. I get back a total of $1.1 million. Because there's also this storing function that I just mentioned, is that this reduction of loan, yes, every month you're using the money to pay for installment, you don't really see that money, but that is unlocked at the end when you sell the property. So in totality, you take this 1.1 million, but originally you only come out with 500K, but you see this at one go because your loan has also been paid down. All right. So when that happens, usually people refunnel this into the next property as the next set of down payment. Then you can buy something in the $3 million range or $3.5 million range. So that's how property investment work, and that's the beauty of it. So if you want to learn more about real estate investment concept, stay tuned for the next episode. But also just to share with you on some key developments that we have is that if you're in an event of really analyzing new launch investments, we have this balloting day playbook. I'm going to cut over to the balloting day playbook for you, and that could probably help you, because if you want to come for a one-to-one consultation over the next 3 to 6 months to understand about some of the launches that's happening in the next 6 months period, we have this game day playbook that really help our investors a lot when it comes to managing their emotions when it comes to investment, and really not to miss out and potentially save $100,000 to $150,000 by not investing in some of the highest quantum property if you are coming from an investor point of view. So let's cut to this short little sharing on our balloting day playbook, and then we'll see you on the next episode. Take care. So what is the balloting day analysis kit? All our consultants at KW Singapore and PLB, they are armed with the disparity effect analysis toolkit, stack ranking toolkit, appreciation simulation analytics, cross-launch comparison across all the new launches in Singapore, and a snake queue live pricing analysis tool. Now the rationale, we come up with this 6-step process because a lot of years of experience, we realize that most of the time, if I'm somebody that's investing in a new development, I managed to get a balloting on that day. Most of my entire day is spent at the snake queue. Alright, so once my turn is called, I show up at the appointed joint marketing agency's office, and the moment that I queue most of the time is that I do not have live pricing updates on what's available. So most of the time, maybe I will only get, based on my stack, what is the pricing that's available, the floor level that is left, and by the time I queue that, maybe I'm left with level 7, 8, 11 and 12. And importantly is that I want to take my emotions out of this because I want to have a holistic view of what's available. Our realtors and our consultants on the ground, whenever they help our clients to go for new project balloting, they already have armed themselves with pre-research. They'll sit down on a tabletop strategy session with our clients. This is really to look at the target investment property vis-a-vis all the resale competition in that district. Because what's important is, in 4 years' time, my investment is competitive in the whole district's resale market landscape. And thus, we have the master disparity effect analysis. We also have the stack analysis on the entry price and quantum strategy by looking on a stack basis. What is the quantum? We have the pros and cons and the strength of each stack. And of course, we all know no properties and stack fixing is perfect. And just understand what will be the potential advantage and disadvantages of each stack and how to balance the entry price. Most importantly, we also want to have a simulation of our exit PSF and exit quantum in 4 years' time to see if this particular stack makes sense. And we have this newly coded toolkit. Basically, it has all the entry quantum and entry PSF of all the launches based on bedroom types in the entire Singapore. So if you want to compare this together with our consultants on the tabletop discussion, that's available as well. And most importantly, we have the snake queue live pricing stack disparity analysis, because this allows us to update our clients while we are queuing up on what are the units sold and available, so that we can know the differentiation. For example, if I'm zoning on a particular stack, by my turn, I'm left with only the high quantum units. If I have an opportunity to see what's available, the next bedroom type, on the next bigger size or smaller size, I can make an informed decision on whether should I go for the other stack, because there's still units available. We call this basically the potential to save a certain quantum by shifting to a bigger size opportunity. And this is basically workable because we have our live research team deployed on site on launch day, just to remove our emotions out of the picture. And this has been some of our successful clients. And in summary, our consultants at PropertyLimBrothers as well as Keller Williams Singapore, they are all well trained to have all these toolkits to facilitate with our clients. And this basically is through our one-to-one consultation. So if you are keen, you can click on the link right down below. That will bring you to our landing page. Just need to key in your name, contact details, and our client care team will be in touch with you. So we hope to see you on the launch day. Meantime, take care. Let's say, oops, I need to sign in. Let me sign in. Oh shucks, I forgot my password. This part, let me cut it off a little bit. Please.